Equity financing is the process of raising capital through the sale of shares in an enterprise. Equity financing essentially refers to the sale of an ownership interest to raise funds for business purposes.
There are various sources of equity financing for entrepreneurs. Some companies might be looking for sources of short-term equity financing, whereas some may welcome sources of long-term equity financing. Here we are going through some of the sources of equity financing. Selling stock, retained earning, venture capital and private placement.
First sources of equity financing is selling stock, which can be done by IPO. IPO stands for Initial Public Offering, which means the process of offering shares in a private corporation to the public for the first time. Growing companies that need capital will frequently use IPOs to raise money.
For example, on 2012, Facebook made its IPO on New York Stock Exchange by selling 421.2 million shares for $38 for a piece and accumulating $16 billion in new capital. The second one is secondary market. The secondary market is where investors buy and sell securities they already own. It is what most people typically think as stock market. Those stocks are also sold on the primary market when they are first issued. For example, the national exchange such as New York Stock Exchange (NYSE) and the Nasdaq are a secondary market. Next is common stock. The term stock refers to ownership or equity in a firm. It's a security that represents ownership in a corporation. Holders of common stock exercise control by electing a board of directors and voting on corporate policy. Common shareholders have rights to a company's assets only after bondholders, preferred shareholders and other debt holders are paid in full. Next is preferred stock. The preferred stockholders have a higher claim to dividend or asset distribution than common stockholders. The details of each preferred stock depends on the issue. For example, Wells Fargo and Company has several bonds available on the secondary market. It also has preferred stock such as its Series L and also provide common stock.
Retained earning. Most large corporations distribute only a portion of their after-tax earnings to shareholders. The portion of a corporation's profits that is not distributed to stockholders is called retained earnings. Okay, because retained earnings are undistributed profits, they are considered a form of equity financing.
Venture capital is money invested in small firms that have the potential to become very successful. In return for financing, the investors usually receive an equity or ownership position and share in its profits. In our real life, it can happen to small businesses that are just about to grow. Wealthy investors like to invest in such businesses that have long-term growth perspective. This capital is known as venture capital, and the investors are known as venture capitalists. There are three major types of venture capital. The first one is early stage financing. The second one is expansion financing. The last one is acquisition or buyout financing. The most relatable example to all of us is Amanah Saham Nasional Berhad (ASN).
Another method of raising capital is through private placement, when stock or other corporate securities are sold directly to the insurance companies, pension funds, or large institutional investors.